Hello, everyone. Welcome to Dan Daily Finance. If you're new here, my channel is dedicated to helping and empowering individuals to learn and grow when it comes to investing. This is a financial literacy channel focused on helping you achieve your life goals by achieving your financial ones first. For today's topic, I would like to talk about some smart investing tips. First and foremost, I would like to touch on the topic of diversification. If you're new to investing, this might be a bit of a foreign topic to you. However, being diversified in how you approach investing is important. As the saying goes, you don't want to put all of your eggs in one basket. If you do and that basket breaks, you lose everything. The same thing applies to investing. By spreading your money out amongst different opportunities, you can still capture attractive upside while simultaneously protecting yourself should something go wrong. There are different types of diversification that you should be aware of. For instance, there is diversification across asset classes. A good example here would be buying stocks versus bonds. Alternative asset classes include real estate, foreign currency, cryptocurrency, and collectibles such as playing cards. Some examples here include baseball cards and Pokemon cards. On a personal level, I like to collect antique chess pieces, boards, clocks, and more. And I always do it with an investment mindset, even though I likely will never sell them. You can also diversify within an asset class. There are different stocks, for instance, that you can buy. You can buy different classes of stock, like preferred stock or common stock. You can also buy stocks of different companies, even going so far as to diversify based on industry, size, growth prospects, geographic focus, and more. The important thing is that you understand what it is that you are investing in. Having said that, part of the reason why you diversify is because you can't know everything about what it is that you are buying into. There is symmetric information and asymmetric information. And the stock market is a game plagued by asymmetric information, where other parties have information that you don't. Experience also plays a big role in how your investments turn out. When I was a novice investor, I made many mistakes. And looking back, diversifying better would have shielded me from my own ignorance. Of course, it's important to not over-diversify. All too often, we'll see investors buy mutual funds or ETFs that individually have exposure to thousands of companies. The problem with diversifying to this extent is that you run into what is called the law of large numbers. The more your portfolio is spread across different investments, the more likely its returns are to mirror the average of all of the assets that those investments fall into. For somebody who is risk-averse and who is not a very experienced investor, the best approach is probably to own 20 or 30 different securities or other types of investments. Another smart investing tip is that it's okay to not knock it out of the park. The goal of many investors is to outperform the market. Some will define this as the S&P 500, but in recent years, the Nasdaq has also become a major benchmark that investors try to outperform. The fact of the matter is that even matching the broader market is fine, especially if your risk profile is on the conservative side. The S&P 500 has achieved an average annualized return of between 11% and 12% for several decades now. If we take $1,000 as a starting amount, invest that in an index fund that tracks the S&P 500, and we add another $200 to this amount every month after 30 years, you will have over $524,000. The total amount invested for this time would only be $73,000. Of course, we also have inflation to take into account. It usually averages about 2% to 4% per year. If we take 3% off of this return, then your inflation-adjusted investment would be worth about $220,000 after 30 years. That is a fantastic return, and you should not feel pressured to outperform the market. The fact of the matter is that retail investing is not for everyone. Even the most generous estimates indicate that 70% of retail investors lose money in any given year. Furthermore, the top 5% of retail investors make 75% of the profits. This means that investing on your own is something that should be approached cautiously. You shouldn't treat this as a casino or a lottery ticket. Instead, you should treat it as a long-term wealth generation machine. Over the years, you should hone your craft. You do that by reading and learning more about the investments that you own and what you're interested in buying. You can also rely on the experts who have demonstrable track records. My own financial technology startup, Echo Investing, is aimed at helping you in that regard. A link to our website can be viewed in the description of this video. Speaking of honing your craft, there are a lot of great resources that you can rely on. I have personally written over 5,000 articles on Seeking Alpha, which is a fantastic investment platform that provides expert insights. I cannot recommend it enough. There are other resources out there as well, including websites, books, scholarly journals, and more. The last smart investing tip that I have for you is to not gamble much. I'm not going to say don't gamble at all. It's not necessarily a bad idea to put a small portion of your portfolio into speculative opportunities. Examples here would be cryptocurrency, options, and penny stocks. But you should only be speculating with what you can absolutely afford to lose when it comes to these opportunities. In general, the market can be a volatile thing, and you should be prepared for it. But when putting your money into speculative opportunities, it should be such a small amount that if you lose it entirely, you don't lose any sleep over it. If it is an amount that you would lose sleep over, it's best to just take a pass on it. So that's all that I have for you today. Thank you so much for tuning in, and I look forward to the next time that we can delve into the exciting world of finance and investing. If you like my content, please follow me, smash that like button, and leave a comment. If you have any questions, ask those as well. At the end of the day, my goal is to help you achieve your financial objectives so that you can live life on your own terms. Until next time.